This is Nightly Business Report with Sue Herrera and Bill Griffith.
Head-spinning market stocks rebound after a steep sell-off, but key questions remain about equities, interest rates, and trade. Seismic shift. There is a big change underway in the market, and long-term investors are trying to figure out what to make of it all and what to do about it. Delayed decision. What did not happen at the meeting of global oil producers and why that may elevate Russia on the world oil stage. Those stories and more tonight on Nightly Business Report for Thursday, December 6th. Good evening, everyone, and welcome. Bill Griffith is off tonight. The drama on Wall Street was kicked up a notch today. Stocks staged a late-day comeback after being down sharply most of the day. Trade and interest rate concerns dominated the trading session until a report in the Wall Street Journal said the Fed may be shifting its way of thinking, and the buyers stepped right in. The Dow Jones Industrial Average finished the day down 79 points to 24,947, but it had been down more than 700 points midday. The Nasdaq rose 29 and the S&P 500 fell 4. But as Bob Pisani reports, the markets may not be out of the woods just yet.
The market's bottom this morning right at the November lows, down 700 points and then rallied 600 points. A very positive bounce off deeply oversold conditions. Now, the Atlanta Fed's Ralph Bostic said interest rates are within shouting distance of neutral. Great news. The IMF's Christine Lagarde said that fears about a global slowdown was overdone and the U.S. was not heading for a recession anytime soon. Then, toward the close, the Wall Street Journal ran a story saying Fed officials were becoming less positive on how fast and how far the central bank will need to go. All of these comments were very helpful, bringing the markets off of the lows, but the rallies still looks very tentative. Even with the Dow down 1,500 points in 2 days at the lows this morning, buying interest still seems kind of muted. There's good reason for everybody to be cautious still. The markets have had 4 big worries. Most are not resolved. Now, the Fed raising rates aggressively is looking less likely. That's good news. That's one, though. But worries about a global oil glut have not been resolved by these recent OPEC meetings. We've had tariffs and trade wars. They're even worse with the arrest of the Huawei CFO in Canada. And despite what Lagarde said, a potential economic slowdown is the big X factor that's making it very hard to figure out 2019 earnings estimates. The debate on the street today is very simple. Do we want a good jobs report or a bad jobs report tomorrow? A bad jobs report will only get the people screaming that there's an economic slowdown already underway, but a bad jobs report will also decrease the chances of more Fed hikes. That would remove a prime obstacle to a bottom. That would be good news. So what do we really want? We don't know. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And earlier today, another Federal Reserve official said the outlook for the economy has grown cloudy, and he, too, is urging patience.
I think at this stage, you're going to hear me be much more cautious and counsel patience. I think there's more uncertainty. Global growth's decelerating. I'm seeing some interest rate sensitive sectors showing some weakness. It's too soon to say what to make of it, but I think this one of the key tools we have as central bank is patience, and I think we ought to be using that tool.
The market has now lowered the probability of an interest rate increase when the central bank policymakers meet later this month. Not that long ago, a December rate hike was a virtual certainty. So what can investors expect from the Fed, the economy, and rates? We'll talk more about that now with Craig Dismuke, chief economist at Vining Sparks. Great to have you with us, Craig. Welcome.
Hey, good evening, Sue.
All right, despite what we just heard, you do expect the Fed to continue to raise rates at least for this month, correct?
I do. I expect they'll hike in December, and I think where you start to get some question about it will come in 2019 and what they do then.
Now, why do you think that they will go ahead and raise rates, given the background of what we've seen today, trade concerns and inflation and the like?
Sure. Well, remember the Fed has to look at a very big picture. We tend to get caught up in the daily movement of the markets, and we see stocks down almost 800 points in a day, and we think is this a turning point or whatnot? The Fed has to look at the big picture, which shows the unemployment rate's still at 3.7. Inflation is near 2%. Wage growth is at its highest level of the cycle. And the economy is still growing at a pace that's faster than what they think is sustainable longer term. So when you look at that bigger picture, I think they still want to go ahead and tighten policy. But I do think it's about time for them to start to be a little bit more patient, as Kaplan said.
Yeah, well, the market is obviously worried, but Main Street may not be. Take a listen to what we heard this morning from JP Morgan Chase CEO Jamie Dimon. Here's what he had to say about the economy and the consumer.
We still have a strong American economy. So if you speak to most of the CEOs, they say their order books are good, consumer balance sheets are good, the economy is growing, wages are going up, they're still hiring people. Unemployment may very well hit 3.3% this year. That's all good.
All of the CEOs that are around here, we all talk and we say things feel pretty good in the U.S.
We believe the consumer's in good shape. We hear the news. We have these same concerns that you guys talk about all the time. But as it relates to the consumer, we're in good shape.
You know, so Craig, I'm kind of struck by the disconnect between what we're hearing from those major CEOs and what the market seems to be anticipating. Are they looking ahead? Things are pretty good now, but maybe not in the future?
Well, I think they're focused specifically on the consumer. When you look at the consumer's in great shape from a debt standpoint, from unemployment, wage growth, et cetera. The bigger challenges right now are coming from external factors, things like the slowing global growth, the risk that business investment remains slow because of the fear of trade tariffs. These are factors that could affect the consumer, and especially if you start to see stock prices fall as a result of that, that could affect consumer confidence. So right now the consumer's in great shape. I agree with those CEOs, but if you see things start to slow down, that could change very quickly.
All right, now we do have a key economic report out which will, as Bob Pisani so aptly put it, either disappoint some people and excite some people, because it may influence where the Fed goes with this. What are you looking for tomorrow?
We're looking for fair job growth. We've had better than expected job growth almost all year, so we expect to see job growth near 170,000. The big key is going to be earnings. If we see average hourly earnings rise above that 3.1%, then it could put more pressure on the Fed to hike. However, it hasn't proven inflationary yet. And remember, inflation is still just a little bit below their target. And so I think they can be patient, but if you see wage growth really ramp up, that makes it more difficult for them.
Craig, thank you very much. Appreciate it. Craig Dismuke with Mining Sparks. Well, the Fed may have lifted stocks off their lows, but investors were rattled most of the day by trade and concerns over an emerging economic Cold War between the world's two largest economies. As Bob mentioned earlier, tensions between the U.S. and China escalated when it was learned that a top Chinese tech executive was arrested in Canada at the request of the U.S. government. Eunice Yoon has more on this new front in the trade dispute.
Many Chinese are seeing the arrest of Huawei CFO as political. Meng Wanzhou was detained on the same day as trade talks between Presidents Trump and President Xi. And Meng isn't just any senior executive. She's the founder's daughter. So most believe the Trump administration did this on purpose to pressure the Chinese as the two sides head into negotiations. An expert known to be close to the Commerce Ministry posted his take on social media, saying the arrest shows that China shouldn't expect the U.S. to keep its word and instead be fully prepared for a long-term confrontation. The Chinese government has expressed outrage over the arrest. The embassy in Canada called it a serious violation of human rights, and the foreign ministry has demanded her immediate release. Huawei put out a statement about Meng, saying the company has been provided very little information regarding the charges and is not aware of any wrongdoing by Ms. Meng. Some American business executives told me that if this is a pressure tactic, it could backfire. They say that President Xi Jinping isn't going to want to appear weak, so they worry about tit-for-tat treatment and that the negotiations between the two sides is going to get that much harder. For Nightly Business Report, I'm Eunice Yoon in Beijing.
So will those trade tensions between the U.S. and Canada get worse from here? And what might that mean for investors? We're joined now by John Rutledge, Chief Investment Officer at Safand. Nice to have you here, John. And you do think this is an escalation?
Well, I do. And like the person who was just speaking, my eyebrows are raised over the specifics of this thing. Arrested almost at the exact time Xi and Trump were having dinner in Buenos Aires, and held under arrest. Hearings not until tomorrow. She was arrested Saturday. The story was just kept under wraps until today. So this has got politics written all over it. The Chinese, Xi, her father is an FOX, friend of Xi, and friends of Xi. Xi will lose face in China if they don't do something to smack us back for this. It's almost guaranteed to do that. Now, what I would worry about is U.S. business people in China.
And what do you mean by that? Obviously, there are a number of very large-scale companies that do business in China, have relationships with Chinese companies there. What might the Chinese do, and what do you mean by you'd be worried about personnel?
Well, the people have talked about how we're in a good trade position because we can tax all of their exports to us and they can't put tariffs on so much of ours. That's baloney. U.S. companies have a huge presence in China. They're actually in China producing products for Chinese middle-class consumers. And those companies are subject to all sorts of what I would call messing around by government officials, anywhere from permits to run their smokestacks, to open their doors, to do you name it. U.S. business leaders in China have complained about that treatment for the last 2 years. And this is going to make that worse. But they're going to do something visible to make sure that this doesn't happen accidentally.
What about if you're a long-term investor and you may hold some of those companies that do business in China that you've just referred to? What do you do?
I think when you see days like today where the prices collapse, I'm a buyer of that today at the bottom. Which companies? I don't own very many Chinese companies. I own some Alibaba, no Huawei. But U.S. S&P earnings are just about half offshore. And a large chunk of that is in China or Greater China, one way or the other. So our earnings here are very vulnerable to things happening in China.
John, thank you very much. John Rutledge with Safanad.
Pleasure.
We often use Boeing shares as a barometer of trade relations with China. The stock fell once again and was the worst performer in the Dow index. Today, the company's CEO explained why China is so important to his company.
I think what you see is some local volatility again in the market because of some trade uncertainty. And we're hopeful coming out of the G20 summit that we're on a path to finding a trade agreement with China that's going to be productive for both the U.S. and China. It's a really important marketplace for us. If you think about aerospace, it's an $8.1 trillion marketplace over the next 10 years. The world needs about 43,000 new commercial airplanes over the next 20 years, and about 7,700 of those are in China. It's the fastest growing market, so very important to us.
From trade to oil, prices fell today over growing concerns that the world's major producers will not reach an agreement to reduce output. Domestic crude dropped more than 2.5% to settle at about $51 a barrel. And as Brian Sullivan reports from Vienna, the drop was due to an unusual move by members of OPEC to delay their production decision.
The building is clearing out, and the podium behind us remains empty here at OPEC's headquarters in Austria because what was expected to happen today did not. For the first time in many, many meetings, OPEC ended their day without any kind of a press announcement regarding a production cut. What the oil cartel was expected to do was come out and make a deal to cut oil production to provide a floor and firm up prices. Oil prices have fallen in November the most in a decade. But either because they could not reach a deal or more likely they are waiting for Russia to arrive tomorrow, OPEC ended their day on Thursday with no deal. The question is this: not only how much will they cut, but how those cuts are distributed across all of the different OPEC members, and what is Russia's role? It is largely expected that OPEC will come up with some kind of a number, probably 1 or 1.5 million barrels of oil, but they would like Russia to also agree to that deal. Russia is not an OPEC member, but is one of the world's biggest producers, has an outsized influence on where the price of oil is globally. So we all will gather back here in Vienna tomorrow where the Russians come in. Hopefully OPEC will be able to reach a deal. Russia will bless that deal as well. And perhaps Vladimir Putin becomes even more powerful on the global oil stage. For Nightly Business Report, I'm Brian Sullivan, Vienna, Austria.
It is time to take a look at some of today's upgrades and downgrades. Facebook's rating was cut to hold from buy at Stifel Nicolaus. The analyst cites concerns that the company's management team has created too many adversaries, including politicians, regulators, consumers, and employees. The price target is $150. Shares rose more than 1% to $139.63. Macy's was downgraded to underweight from neutral at Atlantic Equities. The analyst says expectations are too high and questions the retailer's ability to deliver better than expected earnings and sales. The price target is $28. The stock fell a fraction to $32.37. Activision Blizzard was upgraded to overweight from neutral at JP Morgan. That analyst cites a long-term opportunity in the stock. The price target is $66. Shares rose 3.5% to $48.15. Still ahead, the rise in stock market volatility is not stopping car buyers from borrowing record amounts for a new ride. A number of reports today gave investors some new insight into the economy. We'll start with trade. The deficit hit a 10-year high in October. This as soybean exports fell and imports of consumer goods rose. Factory orders recorded their biggest drop in more than a year in October. That report showed a softness in business spending and also a decline in demand for a range of goods. And private payroll growth slowed in November. According to ADP, the economy added 179,000 private sector jobs, which was below expectations. Economists say, however, a slowing is not out of the ordinary given the tightness of the labor market. In Washington, tech executives visited the White House to discuss emerging technologies. Among those in attendance was Safra Catz of Oracle, Satya Nadella of Microsoft, and Google's CEO Sundar Pichai. The meeting focused on the industries of the future, like 5G, robotics, and artificial intelligence. Also in Washington, General Motors CEO Mary Barra was there, where she met with lawmakers who wanted to know more about GM's restructuring plans. After the meeting, Barra explained why the company is closing plants and laying off workers.
The industry is transforming, and it's important for General Motors to make necessary but incredibly difficult changes to make sure that we can be in a leadership position so General Motors is strong to provide jobs, to provide manufacturing, and to provide leadership in the transportation industry as we move forward.
She met today with Michigan lawmakers, and she spoke with 2 senators from Ohio yesterday. Fiat Chrysler plans to open a new plant in Detroit. The company will manufacture Jeep SUVs and has reportedly already chosen a site. The facility will be the first new auto assembly line to open in Detroit in 27 years. Though there are concerns about the outlook for the economy, we've been reporting that parts of the economy remain very strong, and that includes auto borrowing. New data shows monthly auto loan payments are higher than ever, with a growing number of people borrowing at least $50,000 to buy a new vehicle. Phil LeBeau reports.
America's growing love affair with bigger trucks, SUVs, and crossovers means we're now buying more vehicles with higher sticker prices. So we're borrowing more and spending more each month repaying those loans. In the third quarter, the average auto loan hit a record of just under $31,000, with the average monthly payment for a new vehicle climbing to an all-time high of $530. And the average used vehicle loan payment also hit a record at $381.
If you've been out of the market for 5 or 6 years, then these numbers can be surprising. But for the average consumer who seems to come back into the market every 35, 36 months, they're still a little higher than what they saw previously, and they're certainly not going to go down.
One reason car prices stay high is because demand remains robust. Auto sales are on pace to top 17 million vehicles for a 4th straight year, the best stretch of sales ever in the U.S. So automakers can and will charge higher prices, especially for hot models like pickups and SUVs with the latest features and technology. which explains why Experian says 1 out of every 5 borrowers is now taking out a loan for at least $50,000.
They don't represent a huge portion of the market, but they're definitely the area where we see the most growth. You know, these loan amounts that are over $50,000 and even over $70,000. You know, again, small portion, but definitely growing.
Who is borrowing $50,000 or $60,000 to buy a new vehicle? Those with prime or super prime credit scores, the high end of the credit market. It is also one of the fastest growing parts of the auto loan industry. By comparison, loans to those with the poorest credit scores have dropped to an 11-year low. Phil LeBeau, Nightly Business Report, Chicago.
Signet loses its sparkle, and that's where we begin tonight's market focus. The jewelry retailer reported a wider quarterly loss when compared to a year ago. That overshadowed the company's better-than-expected outlook for a key sales metric. Shares plunged 18% to $41 even. Kroger's profit margin is getting pinched. This as the company ramps up its online investments to better compete with companies like Amazon. But investors focused on better than expected earnings and revenue in the most recent quarter. And as a result, shares rose 3% to $29.56. After the bell, Ulta Beauty said it picked up market share across all major categories this quarter, and that led to stronger than expected profits. But the cosmetics retailer did give disappointing guidance for the holiday season, and that sent shares initially lower in after-hours trading. They ended the regular day, though, up a fraction to $292.92. Also out after the bell, Lululemon gave a weaker than expected quarterly outlook. The guidance overshadowed an otherwise solid quarter at the athletic apparel company. Both earnings and revenue grew above expectations, helped by an increase in same-store sales. Shares were volatile in the after hours, but they finished the regular day down more than 1.5% to $131.44. Coming up, there appears to be a massive shift happening in the market, and it could change the strategy of long-term investors. Here's a look at what to watch for tomorrow. As we reported, the government releases its monthly employment report. Wage growth and its implications for inflation will be in focus. A number of Fed officials are expected to speak on the economy. The Business Roundtable is scheduled to release its CEO Economic Outlook survey, and that is what to watch for on Friday. The government will avoid a partial shutdown at least for the next 2 weeks. Congress approved a temporary spending bill that provides funding to several federal agencies through December 21st. But lawmakers remain at an impasse over whether to fund the president's $5 billion border wall. Democratic leaders are expected to meet with President Trump next week to discuss that funding. Mortgage rates continued to fall this week as increased volatility in the market sent investors into the safe havens like government bonds. Freddie Mac said the average rate on the benchmark 30-year fixed-rate mortgage fell to 4.75%, which is a 2-month low. There has clearly been a massive shift in the market. Some call it seismic. Stocks have been swinging wildly over the past few days and weeks. But what does that mean for long-term investors? Tonight, we're joined by Kara Murphy, Chief Investment Officer at United Capital. Welcome back, Kara. Nice to see you again.
Thanks for having me.
What do you see behind this shift? Because clearly, things are changing and things are different than they were less than a month ago.
So the market is grappling with a couple of different issues that have really been brewing for some time, but have reached a head at the same time. And we've talked about both of them. Number one is trade wars. So we've had saber rattling for a number of months. We've had actual tariffs in place for a number of months. When you look at the actual dollar value relative to economic activity, it's fairly small. So the bigger risk with continued trade wars is the impact on overall company activity. So once you start to have CEOs, say, putting off building the next factory or not hiring the next worker, that's where you start to see the knock-on impact and the negative impact overall on the economy from trade wars. So as President Trump and Xi are meeting, the stakes for those meetings go higher. The other one we've also talked about, which is the Federal Reserve. The Fed has been raising rates for a number of years now. They've been very slow, very methodical about it, so none of that is a surprise. But as rates have ratcheted up, we've also been seeing expectations for global growth coming down. And as those two things, they're reaching a bit of a tipping point where the market has started to be concerned that the Fed is pushing too hard.
So what is the long-term investor supposed to do with all of this? Because we're also hearing positive comments from CEOs that have their finger on Main Street and the pulse of the economy. If you're a long-term investor, how do you handle the volatility and the shift that we're seeing in the market?
So I think the most important thing to remember is, as you said, the economy is actually fairly strong right now. It's definitely decelerated over the last couple of months. But even looking into 2019, we think companies are going to continue to grow earnings. Wages are continuing to increase. So though there are warning signs flashing, we don't see the prospective 2019 growth changing all that much. Now, the other thing I would say is 2017, we saw volatility very, very low.
Right.
2018, volatility has ticked up.
Indeed.
And that is alarming. But that doesn't mean that you should be changing your strategy. It's most important to stay focused on the long term, not to be reacting to each of these headlines on a day-to-day basis.
And you're recommending healthcare and insurance. Kara, thank you very much for joining us. Kara Murphy with United Capital.
Thank you.
Before we go, here's a look at the final numbers from Wall Street. A volatile session. The Dow finished down 79 points to 24,947. The Nasdaq rose 29. The S&P 500 fell 4. And that will do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks so much for joining us. Have a great evening, everyone, and we'll see you tomorrow.